It started quietly, no press conference, no headlines, not even a mass email. One day, longtime Fidelity investors logged into their accounts and noticed something strange. A handful of bond funds they'd been holding, contributing to, or planning to rebalance into were simply gone. No longer available to purchase. No explanation. Just a quiet freeze, a subtle removal, like the fund never existed. For years, bond funds have been marketed as the safe, reliable backbone of a diversified portfolio. They're where retirees park their money for stability. They're what 401k target date funds lean on to balance market swings. They're the go-to option for conservative investors who want peace of mind, not roller coaster returns. So, why would a financial giant like Fidelity, known for its broad access and rock-solid reputation, suddenly pull certain bond products without any public statement? And more importantly, what risk did they see coming that they didn't say out loud? Because if the quiet removal of these funds signals something deeper, something about liquidity, exposure, or another brewing bond market shock, it could mean that the people who were told their portfolios were safe are actually standing on much shakier ground than they realized. And here's the unsettling part. This isn't just about Fidelity. This could be the early tremor of a much larger shift across the financial system, one that leaves average investors blindsided while the insiders quietly get out first. In this video, we're breaking down what really happened, what it could mean for your money, and the hidden risk that might already be sitting in your portfolio. Stay with me, because what Fidelity didn't say might be more important than anything they ever have. Most investors didn't even realize it happened until they tried to make a move. Maybe rebalance a portfolio, increase a position, or add a steady income stream to their retirement plan. That's when they noticed the change. A fund that was once available, one they may have held for years, was no longer showing up. In some cases, it was grayed out. In others, it simply vanished from a buy list. Fidelity had pulled access to several of its bond funds, including some with decades of history and billions under management. There was no official press release, no investor alert, just a silent update buried in the platform's internal settings. A few sharp-eyed users on Reddit and Bogleheads started raising questions. Why can't I buy more shares of this fund? Why does my advisor say we need to reassess my bond allocation? But the answers were vague at best. Fidelity support staff offered neutral explanations, citing internal changes, streamlining, or shifts in fund offerings. But here's what we do know. Several bond funds, including inflation-protected and long-duration products, were either closed to new investors, merged, or placed under new restrictions in recent quarters. Some were quietly removed from model portfolios altogether. And this wasn't a glitch. These were deliberate internal moves. That's what makes it alarming. When a financial giant starts pruning stable, conservative bond funds without saying much, it raises a critical question. Why now? If these were once considered safe staples, what changed behind the scenes that made Fidelity decide they no longer fit? The silence speaks volumes. And it's just the beginning of what may be a much larger story. The timing of Fidelity's quiet fund removals isn't just odd, it's suspicious. If you look closely, the decision aligns with one of the most volatile stretches in the bond market in over a decade. After 2 years of rapid interest rate hikes, the worst was supposedly behind us. Inflation had cooled, the Fed hinted at a pause, and long-duration bond prices had already cratered. So why now? Why freeze or limit access to bond funds just when the storm appeared to be calming down? That's what has analysts whispering behind the scenes. Some believe Fidelity's internal risk models may be signaling something that hasn't hit the headlines yet. A potential second wave of bond devaluation, a squeeze in Treasury liquidity, or even deeper issues brewing in the corporate bond sector that could lead to redemption pressure. Remember, fund companies like Fidelity have a front-row seat to investor behavior. They can see capital inflows and outflows in real time. If they notice patterns like mass withdrawals, rising redemption requests, or signs of investor panic, they don't need to wait for the market to confirm anything. They act, and often they act quietly. What looks like routine rebalancing to the average investor might actually be strategic damage control. By freezing certain funds now, they can avoid future blowback from clients when losses deepen. They reduce the risk of mass panic, lock in control, and protect their internal balance sheets. It's the financial equivalent of boarding up the windows before the hurricane makes landfall. No alarms, no press, just quiet preparation. The kind you only notice when you realize the doors have been locked and you're still inside. One of the biggest misconceptions among everyday investors is that long-duration bonds are safe, simply because they're issued by stable institutions or tied to government securities. But what many don't understand is that duration, not credit rating, is often the real danger. The longer the duration, the more sensitive a bond fund is to changes in interest rates. And over the past 2 years, those changes have been anything but mild. When rates rise, bond prices fall. It's not theory, it's math. And long-duration bond funds have taken a beating because they lock investors into fixed interest payments for longer periods. So, when new bonds offer higher yields, the older ones become less attractive and their market value drops. In 2022 alone, some long-term bond funds lost over 20%, wiping out years of steady gains. Yet many investors, especially retirees, were pushed into these funds through target date products, income-focused portfolios, or risk-managed strategies that relied on traditional safe allocation models. But here's where it gets worse. With inflation still sticky and the Fed signaling higher for longer, these long-duration funds aren't just bruised, they're exposed. If interest rates remain elevated or rise again, the next leg down could be even more painful. That's why Fidelity may be backing away. Not because these funds have already lost value, but because the damage might not be done yet. By removing or restricting them now, they're minimizing exposure to a slow-motion collapse. They're protecting themselves from investor backlash and reputational risk. But regular investors? Many are still sitting in those funds, unaware that what they were told was low risk is actually one of the most interest rate-sensitive assets they own. And that sensitivity could turn deadly if rates stay stubborn or, worse, go higher. Most investors never read a prospectus. And even those who do usually skip over the dense legal jargon buried in the middle, the fine print filled with words like duration, sensitivity, liquidity stress, and redemption restrictions. But that's exactly where the warnings hide. Fidelity, like every fund provider, includes clauses that give them enormous flexibility during market volatility. They don't have to issue a press release if they decide to freeze contributions, merge a fund, or restrict redemptions. All of that is already pre-approved, in writing, buried in documents few people ever open. And that's what makes this so dangerous. Bond funds, especially those pitched as core or conservative, are usually sold with calming language, stable, reliable, income generating. But the reality is, when markets tighten, bond liquidity can dry up faster than anyone expects. If too many investors try to exit a fund at once, especially a long-duration one with thin trading volume, fund managers can either dump assets at a loss or restrict withdrawals to stabilize the situation. Neither is good for the investor. The fund may survive, but your returns take the hit. And Fidelity doesn't have to wait until panic sets into act. They can proactively remove exposure, restrict access, or rebalance internally, long before any headlines hit. That's likely what happened here. It wasn't about crashing prices in the moment. It was about what could happen if markets break again. Investors looking at their portfolios today might feel calm, but the risk is already coded into the system. It's just been masked by years of messaging that told people bond funds were the safe part of their plan. In reality, those safety nets have always had trapdoors built in. If you're like most working Americans, you probably haven't looked too closely at what's actually inside your 401k. The default options, the target date funds, the moderate or conservative allocations, they're all built to feel safe and automated. And for years, that model worked. But when Fidelity quietly removes or restricts access to specific bond funds, the ripple effect on retirement accounts is far more serious than most people realize. These aren't just mutual funds for DIY investors. Many of these bond products serve as foundational components inside thousands of employer-sponsored plans across the country. When one gets pulled, it can force automatic reallocation behind the scenes. Suddenly, your money might be moved into a money market fund, a stable value product, or something with a completely different risk profile, all without you making a single decision. That's how subtle this shift is. You don't get a warning. You don't get a headline. You just log in and notice that your expected return looks different or your portfolio feels strangely off balance. Some retirement plans will even auto-redirect new contributions away from a discontinued bond fund and into something that isn't even close in structure. But the worst part, most plan participants have no idea it's happening. They're not watching the bond market. They're not monitoring fund closures. They're trusting the system to work. And that's exactly why this quiet removal of bond funds by Fidelity matters so much. Because when institutions make moves in the background and the average saver doesn't even know what questions to ask, it creates a gap, a knowledge gap, a risk gap. And for many nearing retirement, that gap could cost more than they realize. When a firm like Fidelity makes a quiet move, it's rarely isolated. It's often the first domino in a chain reaction that hasn't hit the public radar yet. And if you know where to look, you'll start seeing the pattern. Across the financial industry, other major players like Vanguard, BlackRock, and even PIMCO have begun trimming exposure to certain segments of the bond market, especially long-duration treasuries, mortgage-backed securities, and high-yield corporates. These aren't minor rebalances. These are broad, structural shifts, moves that suggest institutions are bracing for something deeper. Maybe it's not just interest rate pressure. Maybe it's the fear of another liquidity event. Maybe it's concern over how quickly the Treasury is issuing new debt or how little appetite global markets seem to have for absorbing it. Whatever it is, these quiet reallocations are rarely about the past. They're about avoiding future headlines. And Fidelity's removal of specific bond funds fits that pattern perfectly. The average investor doesn't know about the backroom meetings, the stress tests, or the internal models that flash red long before anyone in the public hears a word. But when a fund quietly disappears or your portfolio gets nudged into a safer option without explanation, you can bet it wasn't random. The big firms are preparing for something that doesn't show up in today's performance charts, but could hit hard if markets lock up again. And if that happens, the investors left holding long-duration paper won't be the ones who made the move. They'll be the ones who missed the warning. Because in finance, silence often speaks louder than a press release. What makes this story so unsettling isn't just that Fidelity pulled certain bond funds. It's how quietly it all happened. No banners, no client alerts, just a subtle shift that only the most observant investors caught in real time. And that silence says more than a press conference ever could. It suggests that the risks ahead might be serious enough that Fidelity would rather act first and explain later, if at all. These funds weren't speculative junk. They were core holdings, stable, long-standing options for conservative investors, retirees, and 401k participants who believed they were playing it safe. That's what makes the removal so significant. It signals that even the most trusted tools in traditional portfolios are not immune to hidden vulnerabilities. And it reminds us that when institutions move early and quietly, they're not doing it out of paranoia. They're doing it to protect themselves. That's why this matters. Because most investors won't feel the impact right away. They'll still get their monthly statements. They'll still see the words conservative and balanced on their allocations. But under the surface, the safety net may already be fraying. So, if you're holding bond funds, especially long-duration ones, now's the time to dig deeper. Review your positions. Ask what's changed. Look at what's been removed, not just what's been added. Because by the time the headlines catch up, the insiders will already be gone. And if you're not paying attention, you might be the one left holding the risk they didn't want to carry. In a market that rewards awareness and punishes complacency, silence isn't safety, it's your cue to act.